Brent crude just posted its biggest weekly gain since April, up nearly 16% in 5 sessions, closing at 88.10 after a 4.59% single-day rip on Friday. The herd is screaming $100. The headlines are screaming war. And that, right there, is exactly why this week is a trap for 90% of traders. This week has one danger zone and one 3 to 5 day opportunity. I'll show you both right now. Here's what I'm covering. The structural bias for the next 5 days, the exact level that flips the entire weekly outlook, 2 Monday scalping setups designed for the first session's volatility, and 1 swing trade position to capture the core move of the week. Stay to the end. I'm giving you 2 Monday scalps and 1 swing trade that can run the next 3 to 5 days. Here's my weekly verdict. Sideways with a bullish bias, but the risk of a violent rejection at 88.10 to 88.70 is real. The structural bias for the next 3 to 5 days is bullish above 85.44, bearish below 85.44. That's your pivot. That's the line that separates the weekly winners from the losers. Write this number down. 85.44 is your invalidation level for the entire weekly bullish thesis. If Brent closes below 85.44 on the daily, the whole weekly structure resets and we are looking at a flush toward 81.78 or lower. Here's where the herd is positioned coming into the week. Hedge funds just piled into bullish Brent bets at the fastest pace in almost a decade. The speculative community is overwhelmingly long. And when everyone's on the same side of the boat, that's exactly when the liquidity grabs happen. The street is positioned for $90 plus, which means the pain trade could easily be a flush lower to shake out weak hands before any continuation higher. Let's read the chart properly. Not like a reporter, like a trader who's already in the position. Starting on the weekly time frame, Brent is trading above all major moving averages. The MA20 sits at 86.18, MA50 at 81.18, MA100 at 78.64, MA200 at 76.60. Price at 88.10 is extended above the 20-week MA by nearly 2 full dollars. That's a stretch condition that matters for mean reversion risk. The weekly MACD is showing positive momentum at 0.230, but here's what most traders will miss until Wednesday. The momentum is decelerating relative to the price move. We are seeing bullish price action but weakening underlying momentum. That's a classic divergence setup that often precedes a reversal or a consolidation phase. The daily time frame tells us the real story. We just saw a 15.91% weekly surge. That's a massive move in any commodity. The daily RSI at 51.749 is neutral, not overbought, which means there's room to run if the geopolitical premium continues to expand. But the stochastic at 18.799 is flashing oversold on the daily, which is actually bullish for continuation in the near term. Now drop to the 4H timeframe. We are in a strong buy structure across all timeframes from 4H down to 1H. The 4H MA5 at 82.06, MA10 at 85.78, MA20 at 86.18, price at 88.10 is trading above all of them. That's a clean bullish alignment. But the CCI at minus 55.24 is signaling that the recent pullback from the highs has created a momentum vacuum that needs to be filled. The critical levels for this week are non-negotiable. Weekly resistance are 1 at 85.44, already broken, are 2 at 88.10, current price, are 3 at 91.50, projected, weekly support, S1 at 81.78, S2 at 79.53, S3 at 75.87, the weekly pivot. Here's what most traders will miss until Wednesday. The real resistance isn't at 88.10. It's at 88.70 to 89.00, the level that would represent a confirmed breakout above the recent range. And the real support isn't at 85.44, it's the fair value gap between 80.00 to 81.50 that needs to be filled if we get a rejection. Cross-asset linkage. Watch the US dollar index and treasury yields this week. A stronger dollar and rising yields will cap oil gains regardless of the geopolitical narrative. And watch the S&P 500. Oil's risk asset shadow means any risk-off move in equities will drag crude lower, geopolitical premium or not. The fundamental driver for this week is simple. Geopolitical risk premium versus demand destruction. Over the last 48 hours, Brent experienced a massive upward surge following reports of retaliatory strikes on energy infrastructure across the Gulf and the near paralysis of tanker traffic in the Strait of Hormuz. The dramatic collapse of prior truces and U.S. blockades completely wiped out previous June lows, pushing prices from under $84 back into the upper $88 range. But here's the tension. The market is pricing in a forever war scenario, yet physical oil markets remain adequately supplied for now. And OPEC Plus just approved another production hike of 188,000 barrels per day starting in August. That's the fifth consecutive monthly increase, a supply-side headwind that's been completely ignored by the geopolitical bid. The weekly calendar is where this narrative gets tested. Monday, Asian session opens with the full geopolitical premium priced in. Watch for gap fills Tuesday. New Zealand inflation data, 4% expected, impacts global inflation narrative Wednesday. EIA crude oil inventories, the week's biggest catalyst. The market is expecting a draw, but the whisper number is larger than the consensus Thursday. Flash manufacturing and services PMIs for the US, Eurozone, and China Friday. End of week positioning. The big money decides whether to hold or hedge into the weekend. Wednesday's EIA report is the week's fuse. If inventories draw more than expected, Brent punches through 90. If they draw less, or God forbid build, the geopolitical premium evaporates and we flush. The 1 to 2 week directional lean is cautiously bullish with a short-term bearish risk. I expect consolidation between 85.44 and 88.70 for the first half of the week, with a breakout or breakdown determined by Wednesday's data. The event that invalidates the bullish thesis. A diplomatic breakthrough between the US and Iran that reopens the Strait of Hormuz. If that happens, we are back to 75 to 80 in 48 hours. Do you think Brent closes above 90 this Friday? Comment yes or no. I'm tracking consensus for the week. Most people skip the planning phase. That's exactly where this week's money is made. Keep watching. I've got 3 setups for you. 2 Monday scalps designed for the first session's volatility, and 1 3 to 5 day swing position to capture the week's core move. Strategy 1. The Monday opening scalp. Scalping. High probability. This is for the first 1 to 3 hours of Monday session. The Asian session has already traded, and European traders are about to step in with fresh positioning. The trigger condition. If price retests 87.50 and holds a 5-minute bullish close above the 20-period EMA on the 5-minute chart. Entry. 87.55, 5M bullish reclaim, stop loss. 87.05, tight, 50 cents below entry. Just below the Asian session low. Take profit 1. 88.40, that's your scalp target. 85 cents of risk for 85 cents of reward. 1:1 take profit 2. 88.80. If momentum accelerates, 1:1.5 risk. Reward. 1:1.5R on TP2. What instantly voids the Monday scalp? If the 5-minute candle closes below 87.00 before we get our entry trigger. That tells us the sellers are in control and the scalp is invalid. The Monday opening SCLP entry. 87.55, 5M bullish reclaim, stop loss. 87.05 take profit 1. 88.40 take profit 2. 88.80 risk, reward. 1:1.5R invalidation. Void if 5M candle closes below 87.00. Strategy 2. The Monday liquidity grab, scalping, counter noise. This is the contrarian play. The herd is overwhelmingly long. Hedge funds are piling into bullish bets at the fastest pace in a decade. That means there's a massive pile of stop losses sitting just below Friday's low, waiting to get triggered. The stop-hunt zone is 85.50 to 85.80, just below the weekly pivot at 85.87 and above the 4H support at 85.44. Entry after a fake breakout below 85.80 and a snapback 5-minute bullish close above 86.00. Entry. 86.00, snapback confirmation, stop loss. 85.30, just below the stop-hunt zone, giving the liquidity grab room to work. Take profit 1. 86.80, the nearest liquidity pool above, 80 cents off. Risk for 80 cents reward. Take profit 2. 87.50. If momentum reverses fully, 1:1.8R risk reward. 1:1.8R on TP2 warning. This requires aggressive execution. You need to be watching the 5-minute chart in real time and pull the trigger the moment you see the snapback confirmation. The Monday liquidity GRAB entry, 86.00, snapback above stop hunt zone, stop loss, 85.30 take profit 1, 86.80 take profit 2, 87.50 risk reward, 1:1.8R invalidation. Void if 5M candle closes below 85.00, are you scalping Monday or swinging the week? Comment scalp or swing. Let's see who's built for this market. Strategy 3. 3 to 5 day swing. Swing, trend alignment. This is the trade that matters. This is positioned to capture the core move of the whole week. Based on the weekly or daily bias, the trigger condition is a daily close above the 20-day MA at 86.18 with bullish MACD confirmation. We are already above that level, so the entry is triggered on Monday's daily close if we hold above 86.18. Entry, 86.50, after daily close above 20 MA with bullish MACD, stop loss, 83.50, placed below the weekly support at 85.44 and the 4H support zone, giving the trade room to breathe through Wednesday's volatility. Take profit 1, 89.00, conservative swing target for midweek. 3.00 points of risk for 2.50 points reward, 0.83R take profit 2, 91.50, stretch target for Friday, 3.00 points risk for 5.00 points reward, 1.67R risk reward, 1:1.67R. On TP2 trailing stop rule, once price reaches 88.00, halfway to TP1, move stop to break-even at 86.50. Once TP1 is hit at 89.00, move stop to 87.50 and let it ride for TP2 to explicit invalidation. If daily closes below 85.44, the entire weekly bullish structure is negated and the swing trade is void. A 3 to 5 day STRNG entry, 86.50, daily close above 20 MA with bullish MACD, stop loss. 83.50 take profit 1, 89.00 take profit 2, 91.50 risk reward, 1:1.67R invalidation, void if daily close below 85.44. Never risk more than 1 to 2% per trade on these setups. Holding through Wednesday's EIA release requires tighter sizing. I'd scale into the swing with half position before the data and add the other half after the reaction. Stops are non-negotiable, especially on the swing. The geopolitical premium can evaporate in a single headline. And that's exactly how accounts get blown up. This is how you survive to trade the next big weekly move. Let me summarize the single most critical level for the entire week, 85.44. That's the line that separates the weekly winners from the losers. Above it, we are targeting 89.00, then 91.50. Below it, we are looking at a flush to 81.78, possibly 79.53. If this level breaks on Friday, the whole monthly trend flips lower. I'll have the updated blueprint for you this Sunday if you want last week's recap to see how we got here. From 70.13 to 88.10 in just a few weeks, that video is live now. Tap the end screen. Then hit the bell so Sunday's next week ahead alert lands before the open. Hold the like button and subscribe. Every signal helps the algorithm bring you the levels that define your week. This is the Market Meridian. Trade the levels, not the news. I'll see you Monday.